It's time for the Your Personal Bank Show with Ference Toth, financial literacy educator and speaker, entrepreneur, and chairman of the board of a bank in formation. Take charge of your financial future with Your Personal Bank. Now here's Ference Toth.
All right, welcome to Your Personal Bank Show, and Happy New Year to everyone. Of course, if you didn't hear the show Tuesday, I encourage you to go back to it. Go to yourpersonalbank.com, and you can listen to it. We talked a lot about the 2020, some of the the issues, and also some of the positive stuff that had happened, and then of course, kind of thinking forward 2021, what we're looking at, what potentially is going to happen, what are we going to be doing. So again, if you missed it, go back to yourpersonalbank.com. You listen to it anytime. And one of the things I guess I want to, I'm really excited about this year. I think with, like I said in the previous show a couple of days ago, is with all the pent-up demand and energy, because, a lot of people got kind of shut down and bottled up. And that human spirit, we want to accomplish things. We want to do things. We want to, that's how many of us are made. And so there were a lot of good things came from it in terms of being able to recharge your batteries. Maybe there's a lot of stress involved because a lot of change for a lot of people, businesses, things like that had to change, jobs, working from home, adapting, all those kinds of things that happen for so many people. But a lot of good stuff came of it too, because many folks like myself got to spend even more time with their loved ones and things like that. So, although weren't able to like extended families, maybe not so much, but at least immediate folks, the ones you were living with, sheltering with, as they put it, if those are folks you liked, hopefully it is, hopefully you did, you got to spend more time with them, and that was good. Helped us focus on what's really important. And the other thing I'm going to encourage, if you missed it also, is New Year's Eve, we aired a show on basically the Wheel of Life. This is it's not a new idea, but it's something that really impacted my life over 20 years ago. I've shared this with over 2 decades with our staff, Salesforce, every January. And people ask for it now. And so I shared the whole idea of the Wheel of Life, of how to work on, it's a self-improvement thing, on how becoming a better person all around, not just about money, although that's one of the 4 aspects: health, relationships, spiritual, those are the other areas, but how to become a more well-rounded or a better person and be a happier person with your wheel is smoother. You're not going through life like a flat tire where it's bumpy. You know what I mean? So again, I highly encourage anybody that missed that, go to yourpersonalbank.com, check it out. It aired New Year's Eve, December 31st. You can pass that on to anyone you think that might be interested. That'd be great. But one of the things I wanted to kind of talk about for this year and think about going forward and getting some a lot of positive feedback, some positive, not constructive criticism, really what it was, ideas, suggestions by various listeners and producers and things like that. Is, I get a lot of questions about Your Personal Bank. And Your Personal Bank is definitely, for most people that are, I talk to, it's a new idea that's being introduced to them. Some have been introduced to the idea or have kind of poked it with a stick, so to speak, or heard about it maybe, but I haven't really looked into it. The few that have, even, I found, are typically pretty intrigued by the idea, but unfortunately, there's just so little amount of information out there. There's a few good books. I've recommended several of them. My favorite is Financial Independence for the 21st Century by Dave Burnell. I've had a couple long conversations with him. I've tried to get him on the show. I'm still working on that to interview him. But I thought he did a great, one of the best books on this subject that I've read. Unfortunately, some of it's a little bit outdated now because we're using not only the policies to maximize cash value, but we're also using the bank lines of credit to get the positive arbitrage, which really takes the whole idea, turbocharges the whole idea, takes it to another level. My point is, the folks that I've run into who have been introduced to this idea and have spent some time looking into it and maybe even implemented it, for the most part have had success with it, no question. The problem is the advisor or the person they worked with had some knowledge, but I wouldn't say was an expert. How's that in most cases? And what didn't really look at all the different options in terms of all the different companies that could be done to maximize the cash growth. Understand the key to the power of this, there's three things that are really important here. What's your dividend rate? What are you getting paid consistently over time? You want to be among the highest dividend paying, highest rates you can get. And I'll show you the chart of pretty much all the top dividend paying companies put together by one of the financial institutions I work with that shows what the dividends have been paid by all these different companies for the last 25 years. And most of these companies have been paying dividends for over 100 years consistently, never miss. Some of them since before the Civil War, literally. And like I said, we've got companies that are still paying 6% today, even with this interest rate environment. So that's super powerful, okay? Now, there's another aspect to it. You know, there's costs and fees to any financial investment. So you want the one with the highest dividends, of course, but you also want to have the lowest fees possible. So just because one happens to pay a little bit higher dividend than another doesn't mean it's necessarily the best option, because the one with the higher dividend might also have higher fees, which offsets the end result. So that's important to understand. So you got to compare, okay? And the way to compare is run an illustration. We do this all the time. We run illustrations to compare versus different companies. And if somebody already has one or is looking at one, I'm happy to compare the two and do an apples to apples comparison and show you the difference. I always say, look, let the numbers talk. The numbers will tell you which one's the better tool, better option. Because the illustrations, the cool thing about those are they're all encompassing. They encompass all costs, all fees, everything. Which, by the way, which is one of the big questions I get all the time too. I guess I'll hit on that. Before I answer that question, though, let me do this. One of the suggestions, I should say, was given to me by one of the producers I thought was really good, was he said, well, the content, what you've been sharing is awesome. He says, I actually really enjoy listening. And this is somebody who's been in radio for decades, literally. He says the information, the education that you're sharing, he was very complimentary. He loved it, which, you know, I appreciate. That's great. And that's my goal. He says, but he encouraged me to invite the listeners, into more of the answering the questions that I get. And he's right. I will bring up different things at times where I'll say, hey, I'm working with somebody this past week, and this was a question that came up, or I was emailed this question or whatever. But here's what I'm going to invite everybody to do is, if you go to yourpersonalbank.com and you just have a question you would like me to answer on the air, I'll be happy to do that for you. So just go to yourpersonalbank.com and type in what's your question. And I read those. I'll get back with you, and we'll talk about it. In fact, one situation comes to mind. I was talking to a recent new client a few months ago, and he was listening to the show shortly after we had implemented his case. And he texted me, and then we talked later. He called. He says, I got a kick out of it. He says, I knew you were talking about my situation. I said, yes, I was. And the point being is, when I'm bringing up these different situations and these questions or things that people have, these are all real live situations I'm dealing with. This is live fire. I'm dealing with people on a regular basis, on a daily, weekly basis, on Your Personal Banks, helping them understand how this works, designing a case situation, maximizes cash growth for them, minimizes expenses, minimizes taxes. And by the way, the expenses are very competitive to most any other investment folks are familiar with, okay? That's one of the questions I get all the time is, well, what's the cost of insurance and all that? Here's the thing to understand about that. Traditional insurance purpose, if you're maximizing death benefit protection and minimizing premium, pretty much all the money you're putting into is going towards death benefit, of course. Therefore, that's where all the costs and fees are. We do the opposite. If we're minimizing the cost of the amount of insurance, death benefit protection, we're also minimizing the costs and the fees. And like I said, we'll cut those from anywhere from 0.5% to 90%, depending on the situation, which means we're lowering the costs and fees by 50 to 90%. Automatically. So it becomes very competitive. So again, I'm going to encourage people to contact us at yourpersonalbank.com with your questions, ask what you want to ask. I'll be happy to go through some of the better questions. I'll put them on the air and we'll talk about them. So stay tuned in the next segment. We're going to talk about a few more things about Your Personal Bank going forward this next year and what we look forward to seeing. So stay tuned.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com. Back to the Your Personal Bank Show with Ference Toth.
All right, welcome back. And like I said, looking forward to an exciting year. Happy New Year to everyone. And we're looking forward to basically making a difference in people's lives. And as I was sharing the last show, I think it was, why should you consider looking into this? Well, one reason may just be that might be one of your New Year's resolutions, right? To learn something new. I mean, certainly one of the major things that make people successful, any study, anything you read about folks that are successful, always talk about education, learning new things, reading a lot of they're readers, okay? They're researchers. They learn new stuff. And one of the things I find is interesting because sometimes people will reach out to me and I'll be talking to them about Your Personal Bank idea, the concept or whatever. And there's some hesitation, maybe is the best word, because they're like, well, why haven't I heard about this before? Why don't I know about this? Well, one of my statements is, look, just because you don't know about something doesn't mean it doesn't exist, and that doesn't mean it's not a valuable thing. It just means you've not been fortunate to be exposed to this idea. And unfortunately, there's a lot of reasons behind it. I've talked about it in previous shows. You can go to yourpersonalbank.com and check out some of those shows where I discuss the reasons why the average individual is just not introduced to this idea. I mean, the short of it is it's primarily focused on, businesses, banks, corporations, wealthy individuals for various reasons. And most, frankly, financial advisors are not introduced to it themselves either, or trained or taught, or even have the product tool or tools available to even do it, even if they wanted to. So there's a lot of that. If you don't know about something or you don't have the tools to offer something, I mean, there's no incentive or reason, frankly, to even talk about it. That's one of the big reasons why have decided to do the show we're going on almost 2 years now, is because the amount of education, the level of understanding of this concept is still so low. I mean, for years, I would go around, the first question I would ask at a workshop or where I was speaking to a group of investors, and I would ask the question, how many people are familiar with the personal bank or insurance banking concept? And if I had a group of 100, I'd get, on average, 2 or 3 hands, literally. That's it. I mean, that gives you, and these are people who are active. Like, these are folks like coming to a half-day workshop on a Saturday to learn more. These are the folks actively learning and actively engaged in investing, okay? I'd hate to see what the percentage of average Americans would be that understood or had been even introduced to this concept. I mean, I think it'd be safe to say less than 1%, okay? Much less than that. And when I'm talking to bankers, or I'm talking to attorneys, or CPAs, or financial advisors, or any other specialty you want to pick, the questions I get in most cases I get a lot of very inquisitive questions. Really, what's that about? Or maybe they might have heard of it peripherally, but that's about the extent of their experience. Most of them haven't even heard, what is that? And so as I start to explain it, they're like, oh, gosh, that makes a lot of sense. And then usually more questions become elicited. And then many times, frankly, those folks become clients. But again, how it works is really quite simple. Some people try to make it more complicated than it is. And I think that's sometimes just a natural knee-jerk reaction to when somebody doesn't understand something and they're supposed to, they're a quote-unquote expert in financial matters, let's say. They're supposed to be kind of and they run into a financial thing that they're not very familiar with. The knee-jerk reaction is just kind of downplay it or poo-poo it, or what I'm saying. Say, you know what, that's not whatever. Or just dismiss it out of hand just because there's a lack of understanding. Really, all it is, or say things like, well, that's complicated, or that's not for you, or whatever. And the reality is it's just they're not familiar with it. Okay. And they're on, their comfort level's not there to discuss it or recommend it even, obviously. I mean, all your personal bank is we set up a high cash value policy that's established to maximize tax favored cash growth. We're trying to maximize growth. We want our money to grow. And we want our money to grow consistently, steadily, ongoing, year in and year out, without risk, market risk, ups and downs, and everything else that's involved in what most people are familiar with when you talk about investments. We want that steady Eddie consistency. Now, why is that so important? Well, there's a lot of reasons why that's so important. First, diversification. In other words, having all your money in one bucket in one place, typically in the long run, doesn't work out for most people. It can work out for a while, but eventually they get caught. In fact, I saw an article I was reading just, I think, a day or so ago, talking about, one of the big time financial advisors. He was saying, I guess in the financial industry, he's talking about, there's a lot of advisors saying the 60-40 modern portfolio theory is dead. Some people are saying that. He goes, it's not dead. In fact, it's still working. And he showed all this. He's been advising people through 2020 even to stick to that 60-40 portfolio mix. And he showed where the average returns were, somewhere in the range of 10% plus. And it outperformed in many cases what people were doing without that portfolio mix. He was showing the numbers to show why it was still working and it's still valid. It's been valid for over 50 years. And his point was it is still valid. I think diversification certainly is valid. Having all your eggs in one basket for most people long term doesn't make a lot of sense. I mean, it does for the folks who are willing to, risk it all. They're willing to, do it. But for the most part, for most people, if you're putting money away for retirement or for the future, or you want to supplement retirement, or you want to live off the money you have for retirement, put it all on one bucket just probably doesn't make a lot of sense. So having some diversification does. And this is a great diversification tool. It's a non-correlated asset. It's not subject to market risk. It's not subject to potential tax liability. So you take a lot of risk off the table. That's big. And you have that consistent, steady Eddie that you can tap into as needed. Another reason I touched on already is taxes. I don't know about you, but does anybody think we might have higher taxes in the future? I mean, it's hard to say depending on our political situation, how it goes forward. And I'm not just talking about this year or next year. I'm talking about over the next decade or two or more even. Can you tell me what tax policy is going to be? Can you tell me what our income tax brackets are going to be, 5 or 10 or 20 years from now even? And of course, the answer is it's impossible to know. The government certainly has spent a lot of money, our money, by the way. We've talked about that before. That's another discussion. But the reality is the government has a lot of debt. How do they pay that back? Well, there's several ways to do that, but one of them is to raise tax rates, isn't it? And certainly, I think any reasonable person would agree that that's going to be looked at and discussed and very likely happen. So to have your money in a situation where it's not subject to income tax, either in the growth, access it, or pass it on to your heirs, just makes a lot of sense. Okay, so that's another reason to look at this. Another one is, I find, is liquidity, access, use of the dollars. Because here's the thing. There's two scenarios that occur most often when we need money. And that usually is either an opportunity presents itself. So we see an opportunity to maybe invest in something to make more. Or we have an emergency, don't we? Something happens unexpected and we need funds. Now, the problem with most investment financial tools are if you're going to access money from that, either involves selling that particular asset, which could involve penalties, taxes, or various other things. But certainly it means you don't have that money growing for you anymore, do you? You moved it from one to another. It might be better, but you took it from one and took it to the other. What I'm going to talk about in the next segment with your personal bank here is how you can actually have access to your money yet still have it grow where it's at. In other words, get that positive arbitrage. Pick up extra return on your investments. Why not increase the rate of return on your investments? And that's one of the biggest questions I get with folks all the time. So stay tuned in the next segment, and we're going to explain that further on how that works, how you can enhance your overall return. So don't miss it.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com. Back to the Your Personal Bank Show with Ference Toth.
All right, welcome back. We're talking about the Your Personal Bank concept, how it works, and sort of some of the reasons why, people haven't been introduced to the idea. And I guess one of the things I want to encourage and challenge folks for is, hey, if one of your New Year's resolutions was to learn something new, well, maybe this might be one of those things you want to learn about. So contact us at yourpersonalbank.com. Or, if you have any questions, by all means, reach out to us, ask your question, and I'll be happy to answer that on the air. So if I get, obviously any of the better questions, give me some good questions, all right? And we'll talk about them. I've brought up some of the things as I work with clients. I work with clients on a regular basis. And when their questions come up or various things, I do bring these up. When I'm using an example or talking about a situation or a story, I can assure you, as I was sharing, I think in the last segment or two, one of my recent clients last fall, he was listening and he texted me, and then we called and we chatted. He was laughing. He goes, "Yeah, I knew you were talking about my situation." I said, "Yeah, I was." Now, I won't share any personal information or who it was or anything, but he goes, "Yeah, based on what you were explaining, it was clear that you were talking about, my situation." I said, "Yeah." Because I felt like your questions and things that you had in the process of getting this set up were very valid and were commonly asked questions that a lot of people had, questions to. So again, anybody have any, want to know more or have any questions? Yeah, reach out to us at yourpersonalbank.com. Love to answer them. I'll do that on the air, or we can do it in person. Your call. You just tell me. If you just want me to answer on air, that'd be fine. If you want to chat in person or do a go-to-meeting, or individually, I should say, you want to go to meeting or whatever, by all means, reach out to us. But the thing is, as I was kind of talking about before, is some of the reasons, like I said, one of the main reasons why I'm doing the show is just the lack of understanding. Again, I would talk to a group of investor group, and, I'd get 2 or 3 hands out of 100 that had even been introduced to the idea. And then when I did even talk to some of those folks who had been introduced or had implemented it, they hadn't implemented the best option that they could. A perfect example, I did this right before Christmas. I've been working on this case for some time prior to that. But this is a gal. They own a trucking company, quite successful, and her and her husband. And they had been introduced to this idea a couple of years ago and had funded high cash value policies and done well with it, don't get me wrong. But then when I showed her the way it was structured, see, it wasn't the most efficient. In fact, so much so that they've decided to switch, and we're switching companies to a company that's going to pay higher dividend rate and lower fees. See, understand the difference, and I'll give you a couple of key quick things to know. If you have looked at this or you want to understand how this works further, and this answers also one of the major questions I get all the time is what are the costs of insurance and fees? Think of a teeter-totter. When you contribute your money into one of these high cash value policies, a certain percentage of the money is going to go to the cash, and some of it's going to go to the death benefit protection. And the more that goes to the cash side, the more cash you're going to have, the more cash growth you're going to have. Now, depending on how we structure it and your age and various factors, there's something called the MEC rule, the Modified Endowment Contract. It's been around since the 1980s. You can look it up. It's part of the tax code. It's been around for, like I said, since the 80s. And basically, it gives us the limits. There's a wide range of how much of the money can go to just the insurance portion versus the cash portion. Now, again, depending on your age and how we set it up, we can get anywhere from 50 to 90% of the money into the cash side, right out the gate. Now, the insurance side grows too. Don't get me wrong. All the money grows. All the money gets credited, dividends, interest. It all grows. The difference is when we're allocating to the cash bucket side, cash is cash. Cash grows, right? That's pretty simple. And like I said, the dividends have been paying out. These companies we have companies still paying 6%, have for the last 25 plus years, never missed a dividend since before the Civil War. Okay. So we got long-term, strong dividend paying companies. Okay. Now, the thing is, the cash is cash. It's going to get credited dividends. The insurance side gets credited dividends also. It's the same. But the cost of insurance and things like that are then taken. A portion of the gain. What it is they don't take it out of there. What happens is a portion of the dividend they pay you is then taken back to pay for the cost of insurance and fees and such. Okay? So the insurance side grows also, just grows a little bit slower because there are some costs involved, right? Like with any financial tool. Okay? That's nothing new about that. Now, the costs, by the way, are front-loaded just like any other financial product pretty much, and mostly in the first couple of years, and then it dissipates and pretty much almost is gone after that, okay? My point is, if we're putting 50 to 90% of the money into the cash side, obviously cash is cash. It's growing, right? The insurance side grows a little slower at first, then catches up, and then both sides are growing pretty much at the same rate going forward the rest of your life, all right? This specific person I was talking to with the trucking company, they put far too much money in the insurance side and not enough in the cash side. So it caused a higher death benefit amount, much higher, like a teeter-totter. You put the death benefit on one side and the cash on the other. What's your teeter-totter look like? Which one's higher? Do you have more cash or do you have more death benefit? You see what I mean? And that can be swing, like I said, 50 to 90% either way. Huge swing. The one she had was far too much to the death benefit side, which caused higher fees, higher costs, less cash growth. So much so that it made sense to switch to a higher dividend paying company, and we reconstructed it, restructured it, so it had much, much higher cash. Now, if you're increasing the cash 50 to 90%, that means you're reducing the death benefit 50 to 90%, aren't you? Which means you're cutting the cost. You're reducing the costs and fees 50 to 90%. So this can become some of the least expensive insurance you've ever owned, okay? The costs and fees and insurance, it dramatically gets reduced. Because, again, our focus is not to maximize death benefit when we're structuring these. Our focus is to maximize cash and cash growth. And then the last part of that is then, how do we access that money? See, whenever you're investing in anything, any financial or any asset, there's two things. Well, there's about three major things, actually four things you really should look at. One is, what's my rate of return? That one's pretty obvious. What are you going to get? Secondly, what's the risk involved? What's the potential risk of loss? That's very, very important. Thirdly, you should look at what's the tax implication. And fourthly, you should also look at, well, what's the distribution capability, or what, when I take the money out, what's going to happen? Well, in many of those areas, that's where your personal bank really shines. And what people miss about it is when they look at the gains, the growth, rate of return. If you're looking at a 6% dividend, for example, some people say, well, I can get a better rate of return elsewhere. I said, I'm sure you can. I don't argue with them on that, but here's what you're missing. I'm not talking, this is not an either or on rate of return. This is not, hey, I'm getting 6% here versus 9% there, okay? This is, if you get the 6% dividend here and you get the positive arbitrage with the bank line, remember, how are you accessing the money? If you're accessing through the bank line, you're earning 6, you're getting charged in the 3s, what's happening? You're still keeping the difference, right? So you're keeping 2 or 3%. So if you tell me you're making 9% elsewhere, I'm going to say, do you want to make an extra 2 or 3% on that? Would you rather make 11 or 12? You see what I'm saying? So one of the first mistakes I see people make and misunderstandings make, it's not their fault, they just don't know any better, is they compare this rate of return to something else. And no, what you have to do is look at, wait a minute, if I'm getting a better rate of return elsewhere, this could enhance that. So on the rate of return side of situation, this is an enhancer. It's not an either or, it's an enhancer, okay? As far as what's the risk, well, if you're talking about guaranteed type, there are guarantees, downside guarantees and minimum return guarantees. So depending on what we structure, we can have where you make no downside, there's no downside in a bad year, or we have some that have 4% minimum contract guarantee every year, no matter what. So you have guarantees here, and that strongly, your personal bank is strongly favorable compared to most anything else out there in that regard. So very strong in that area. So we talked about rate of return and guarantees. We're going to touch on the other two main considerations on any investment, and that's taxes and how do you access the access implications in this next segment. So I'm going to encourage you to stay tuned as always. And of course, if you have any questions or you want to reach out to me, contact me at yourpersonalbank.com. See you on the other side.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com. Back to the Your Personal Bank Show with Ference Toth.
All righty, round and third coming in home now. We've been talking about today about your personal bank and about investments in general. When you're looking at one or considering one, what are some of the key things to look for? Now, obviously, rate of return. What's the risk? Risk of loss, obviously. What's the tax implications? And then when you do access the funds, what are the implications there? Those are some of the big four. There's some others, but those are, generally speaking, probably the big four. And as I stated in some of the other segments, I encourage you, it's a new year, new opportunities. I think 2021 for a lot of people is going to be a better year than last year was. Hopefully so. But maybe learning something new, encourage and challenge you. This could be something to look into, because I don't think anybody can argue successful people are readers, they're educator, they're coachable, they're inquisitive, they research, they learn new things, and that's how they learn and get better. So it's just, it's a good idea to learn something new every chance you get, frankly. This is something that really could impact your life in a financial manner, in a big way. We talked about in the last segment how your personal bank can increase your rate of return, enhance the rate of return on whatever you do invest in. And if you missed it, go back to yourpersonalbank.com, check out the last segment, and you'll see what I'm talking about. I also discussed how this can be, with the guarantees involved, a great diversification tool and a way to make sure that you don't lose, or at least the funds in this bucket don't lose, right? There's no downside market risk, for example. In fact, depending on how we structure it and which option we choose, we have 4% annual contractual guarantees. In other words, you'll never get paid less than 4% no matter what. And again, we got companies been paying 6% or at or better at 6% plus for the last 25 plus years, and for over 100 since, I always like to say, but since before the Civil War. The other two factors of the big four I would consider are taxes. So we talked about, again, rate of return and risk. What about taxes? Well, see, that's one of those risks that I find, at least, working with folks, is often either misunderstood or not paid attention to that much as it should be. And here's what I mean by that. Here's the problem. There's a tax liability. If you have an investment, an asset where either you get taxed on it annually on your growth, or you get taxed when you access the funds, well, you have an uncertainty in terms of what the tax is going to be. In other words, there's a liability. There's a risk in terms of how much is the tax rate going to be in the future. In a year-to-year investment, that's one thing. But when you're talking about a deferral, tax deferral, and particularly, this is where a lot of people, I think, underestimate the tax liability potential. Why is this so important? Well, so many people have IRAs and 401ks, for example. In other words, they put money in it and they're deferring the tax. If it's a traditional IRA, 401k, those types of accounts, they're deferring the tax to some future date when they access the money, when they withdraw it, right? Because you don't pay the tax up front on the traditional accounts. Here's the problem. When you take the money out, when you access it, what's the tax rate going to be at that point? What tax bracket are you going to be in, and what rates are the brackets going to be? And how much income do you have to be at a certain bracket? And if you're talking 5 years, 10 years, 20 years down the road or so, that's impossible to know. So there's a tax risk a future unknown tax risk there that's often underestimated. I mean, in our industry, IRAs and 401ks and such are often referred to as ticking tax time bombs, because in a way they really are. Because, and I'm not saying you shouldn't do it or I'm negative on it. I'm just saying you should understand it and understand what the risk is, and then also have an alternative to that, at least with some of your money. Because if most of, not all your money, I run into this often with people where their majority, if not all of their assets are tied up in these tax deferred type of accounts. And now they move into the retirement phase or stage when they start taking money out of it, and they're getting creamed. And they'll go like, I had no idea. So yeah, you kicked the can down the road, but now you're paying the piper. And if rates increase, which, a lot of people think that's going to happen, I mean, it's no question our government has borrowed a lot of money, right? Especially after 2020. Our tax rate's going to be higher in the future. I mean, I think that's a definite possibility that has to be considered, okay? What are your tax rates going to be in the future? We're still at historically low tax rates when you look at the history of the income tax. And the question needs to be asked, if you're deferring, if you're funding monies into this, I'm not saying make the change. I'm saying look at this, consider it, run the numbers. Does it make sense to continue contributing to something where you're at historically low, relatively low tax rates historically, to be then taking it out and paying out some future unknown rate? In your situation, it may make sense and it may not, but that's something that needs to be considered or looked at. And with any asset or any investment, it should be, okay? Don't just blindly say, well, that's what everybody else is doing. I mean, that's not wise planning. That's not smart. And then the fourth one, probably one that's probably looked at even the least, is when I access the money, what are the implications? This is where your personal bank really shines. Probably it's the strongest point. Because remember, you're growing the money in a high cash value policy. Again, paying the range of 6% dividends, 5-6% is what all the different companies are paying these days. And it's relative based on interest rates going forward. If you have any questions on that, go to the last show, Tuesday show, go to yourpersonalbank.com. We should talk about that. But we're accessing it from a bank line of credit. And today, current rates, getting paid in 5-6, depending on which company and who we're dealing with, and you're accessing it in the 3s, depending on how much money we're dealing with, you're looking at a 2 to 3% positive arbitrage situation in most cases. Well, if you access the money and spend it, which is ultimately the goal, right? With most assets, the goal is at some point you have money to supplement retirement or use it for some other purpose, right? But you still pick up 2 or 3% interest on those dollars. Well, doesn't that mean you're going to have more dollars to spend than if you didn't have that extra 2 or 3%? By the way, for the rest of your life, if you spend $100,000 over some period of time, but you pick up 2 or 3% positive arbitrage, that's $2 or $3 grand in your pocket every year the rest of your life. Think about that. That can add up to a lot of money over time. So you'll have more money to supplement retirement. So to summarize, your personal bank really shines or can enhance your financial results in all of the major 4 areas that need to be considered with any investment. And that is rate of return. It can enhance your rate of return on any investment, any asset investment you want to deal with. It can reduce or eliminate market risk, which is generally a good thing, or at least a good diversification tool. It can reduce your income tax and your future tax liability overall, which again is generally a good thing. And then when you do access and use the money to spend it or whatever, for whatever reason, you can still keep a portion, the positive arbitrage. You're earning more than you're getting charged. So you're still earning interest on some of that money even after you spent it. So you end up having more. So I think you can see when you look at it from this standpoint and you realize, wait a minute, if I'm looking at this as an investment, an asset, and how it works and how it can compare to other things, you put those 4 things together, you can see where it makes an awful lot of sense for most people. So as always, I'm going to encourage folks because, again, for many people, this is a relatively new thing. And for some, you've never seen anything like this, so it's new. Check it out. Hey, it's the beginning of the year. It's a good time to learn something new anyway. But contact us at yourpersonalbank.com. If you have a question, let me know. I'll be happy to answer it individually or on the air even, if you prefer. And if you want more information or you want to chat, let me know that too. We can look at your situation and see how this can truly enhance your financial future for both your your family, your business, whatever. And whatever your financial situation may be, this is a tool, again, that can really enhance everything that you're already doing. I can't stress that enough. I'm not asking you to change what you're doing. If what you're doing is working, keep doing it. Just let's enhance it. Let's make it better. And let's make 2021 an awesome year. So stay tuned to the Your Personal Bank Show, and we'll see you next time.
Listen Tuesday at noon and Thursdays at 1 for more information on Your Personal Bank. Contact Ference at yourpersonalbank.com. This show is designed to provide accurate and authoritative information. The presenter and guest on this program do not engage in legal, accounting, or tax advice. Professional advice regarding your situation should be sought if required. Products and riders may have limitations and may not be available in all states. Excessive unpaid loans may affect performance. Distributions may become taxable if not managed properly. Replacements may not be suitable for everyone. There may be charges when replacing coverage. Compare when considering a replacement. Dividend rates and baseline of credit rates may charge. Contact yourpersonalbank.com for current rates.